Hello ladies and gentlemen, and welcome back. In today's video, we take a look at markets around the world after what many people expected to be a Federal Reserve pivot. We now know that was not the case, and of course it was not our primary thought process leading into this event. In fact, we thought it would move to the short side, and it did. We'll take a look at that later on in today's video. But it's really what's happening underneath the hood in these markets that's disturbing. You'll notice we have the Dow on the charts for the first time in a while. And the reason is because the Dow has been leading this market, a very unusual thing that we covered in the previous videos. But it's the sectors underneath that we should be worried about right now. What's under the hood and what is the market telling us about the next couple of months moving forward? Join us as we go through it all together. Well, welcome back everyone to the show where we talk about stocks, commodities, and cryptos. We'll go through the news events, the macro data, then we'll lead into the lead indicators, and specifically we'll take a look at what happened to interest rates over the last 24 hours before looking at the key levels we need to be watching. So Powell said it's premature to think about pausing interest rate hikes. There was no pivot. In fact, the pivot was from hawkish to more hawkish. Yes, it was realistically just a day of him saying fairly similar things, but there were a couple of big ones. Fed's Powell ultimate level of interest rates will be higher than previously expected. This sent two-year rates up, and of course, it doesn't look like the Fed will be moving to a slower rate hike increase until most likely December or even 2023. Now, the market didn't like this initially. It moved, well, it kind of looked like it would move up on the statement. Then when Powell talked, it moved down. That was contrary to what a lot of people believed would occur. But it brings in line many things we've been discussing on the channel now for the subsequent weeks. A short squeeze followed by a potential short in this market. Now, does that mean that we just saw the start of a bigger short? We will look at that later. But let's talk firstly about smart money versus dumb money. Where does it sit after the last 24 hours? Getting closer to intersecting. Now, we do want to see an intersection. Generally, that has been a great time potentially to be getting out of the market on the long side and to be moving into the short side. So join us if you are interested in, of course, following along on that chart. But I want to talk about sectors within the market. Too many people don't focus on this. Too many people don't think about what's happening underneath the hood. They go to the Nasdaq, they go to the SP500, the Dow, and they say, oh, up or down. What about what's happening underneath? Well, industrials, as we mentioned in the previous videos, has been running the show on the way up here. Energy also doing amazingly. Staples, healthcare, and financials. All of those have very strong trends to the bullish side at the moment. That's interesting. That's not really what you want to be seeing here when it comes to this recovery. Usually in a good, solid recovery, we have other sectors doing well. Discretionary and technology, they are not happening. And we will make a video later on this channel about the key reasons and how we've only found 20% of what usually shows a low in comparison to other turnaround events. Here's some of the industry groups within those. You see here again, telecoms, health insurance, oil and gas, biotech, pharmaceuticals, not the normal ones that you would expect to have strong trends in such a recovery. So again, it probably points to this not being that low kind of building process. The old economy is finding buyers. The new economy, such as semiconductors and internet, is finding incredible sellers that we'll take a look at later. Now, we know that history shows us two-year yields peak around 1 to 1.5 months before the end of the Fed hiking cycle, the terminal rate. We now know that, of course, we still expect the terminal rate to be around March to April of 2023. So this could point to maybe a February kind of hike or highest point for the two-year yield. We didn't see a new high in the two-year, but that's certainly something that could happen over the next coming days. And if it does, then what will happen to the stock market? It may fall further. Conditional seasonality is also with us. A lot of people ignore the bear market years. Bear market years turn usually at the start of November and move to the down low. And then, of course, usually this is an incredible time to own the markets during most years, but not in bear market years, as it turns out. Michael Burry's work is also very similar. I mean, we're about here right now, a dropping VIX, yet fears technically probably increasing across the board from many of you out there, and very similarities to do with the 2006, 2007 kind of period of the market, where we saw VIX staying quite low in comparison to usually maximum fear. And as many of you would know, capitulation, that is maximum fear, generally occurs when we hit like a 45 plus VIX. We have not seen that in 2022 so far. So just remember, if you're a new viewer, these are the types of things that we bring into this show all the time. Let's look at underneath the hood what happened in the market. So it was all kind of okay, down a little bit, down as much as 1%. And then we saw the beginning of the news, and it spiked right into the zone we talked about in the previous video. It literally hit right in there, and then all of a sudden it was over, and we fell heavily after that. Of course, these hawkish statements aren't helping the market. If we talk about which sectors were doing best on the day, it was defensives in general. Some of those ones we discussed, they did better than the others, and everyone wanted to sell metals and gold. And I think a lot of this, well, not so much the metals, but gold really hates high yield. And it was just a huge sell-off on the gold side. There was a whole bunch of reasons, but the main one I think is always interest rates. When we take a look at the last 5 days, you'll notice that some of the best sector performances have actually come out of some of the most defensive sectors. Again, we have gold, we have consumer discretionary, technology, semiconductors after the previous session falling off. And what this is showing us is there's been a bit of a rotation, which we've been warning about and talking about, into defensives during this rally. It's again not something that you usually see. Let's take a look at the refresh here on beats rate. We're now down 1 more percent, 64% beats, 841 versus 470. This is a sub, I would say, optimal kind of earning season. If this was any normal year, you would say this is not good. Of course, at the moment, we already have very, very low, I guess, expectations. 64% is pretty bad. For the earnings moving forward, I know Roku didn't seem to do too well. I'm not sure what the price was after hours, but we had, of course, Etsy and Roku. Now we see PayPal, Coin, Crocs before the market opens, Datadog. It's a lot of those hyper growth stocks coming out with their announcements. How will they fare in a high interest rate environment? How is the market going to perceive their value? Something that will be definitely talked about over the next couple of sessions. And what we'll do is we'll collate some of this and have a look at what's been going on in these smaller caps and whether this is just the beginning of a potential another fall or whether we're about to see significant value in these as they fall back to their previous lows. So let's jump into the markets. Let's talk about the VIX. Yeah, it's going down. Now, a lot of people can't understand this. They say, how can the VIX go down when we saw such a crazy day? Well, it's because we're still within the range. Now, of course, if we make new lows, you would expect the VIX to be spiking out of control. But while we're in a range within the stock market, albeit like a 3.5–4% kind of swing range, generally speaking, it's very difficult for the VIX to go up. There are a few suppressants on this as well. I think too many buyers of VIX. We saw a few weeks ago, people were opening 120 VIX contracts, if you can believe it, or maybe it was even higher. So that's incredibly high VIX contracts, big size, and a lot of people have had 40s and 35s for quite some time. So maybe it takes until they expire for the VIX to spike again. Let's take a look at 2-year yields. So we didn't quite get a new high on this. This is realistically what everyone's watching right now. A new high on the 2-year should spell bad things for the stock market, and several commodities and other things out there may start to struggle or do better off these rates. The 5-year, you can see it spiked a little bit, but not considerably. And the 10-year, what this is showing us is that the forward rate, the 2-year, is going up quite heavily, but the economy is starting to get sick. Notice the 10-year is not moving up to the highs here of 4.3. The economy is starting to get sick, and the markets are starting to present that in the charts. We also saw some pretty massive changes on the forwards. So we saw here, this is the April 2023 forward contract. It made a new peak. Again, those words from the Fed coming out here, making the market freak out about what's going to happen. We saw 5%, a 5 handle finally happen on these markets. And more concerning was the forward. Look at this, September now predicting a 5% interest rate from the Fed. So higher for longer. And in fact, the cuts now don't really show themselves until December of 2023, which is still way higher than before, new highs. And then if we go March 2024, that's where we're currently starting to see maybe a 2-rate cut quickly after each other. Maybe once every quarter they'll cut. That's what the expectation is. So we've got hike, higher than usual, now 5% for longer than usual. All of this starts to pack into price. And of course, that's why we must understand it. What about high yield bonds? Did they like the market? No, they didn't. They came with the market back down. We are following high yield bonds a lot this year. If they make a new low, the stock market doesn't, it's been boding very bad news. So we'll continue to watch high yields as much as possible. Let's talk about dollar index. Where is it? It's right where we expected it to go. One of the key two zones that we've talked about, number one and number two, it's in the first supply. So for dollar, let's say bears, they're going to be looking for turnaround stories right in this zone. Can they find it over the next 24 hours? Remember, we saw a huge spike low. It grabbed all the stop losses, grabbed all the liquidity, instantly went bullish. Now we find ourselves at a key zone for turnaround story, and that will be something that people look at. The euro would be the competitor to that. Of course, the opposite side. Here we have a demand, previously a buying zone, support, whichever you want to call it. And we're starting to see the market testing that zone. Doesn't mean it's going to buy off here, but if you see the right signs, this is the kind of day that people get in and they say, well, this was a big move. Maybe we need to retrace a little bit of that. Otherwise, usually what happens with markets is they'll consolidate, they'll distribute, they'll make a new low, and then we move to the next levels on these euros. So you've got to be very careful around here, but look for the signs, smaller timeframes. It's a good day to consider looking at it. The same thing happened with gold. We saw it spike into these highs, effectively take liquidity, instantly sell off, back down into the demand. It's a great take profit level. Again, we kind of expect some buyers for gold, and then we'll find out whether it's distributing for a new low. So it's worthwhile setting alerts down here. I'm going to just set one now so I know if it does make a new low. And I also might want to know if it comes back up into this zone as well. These are the types of things you do. You focus on the key levels, then you look for the reaction off those key levels. US oil continuously tests this area. Now, there was one strong thing about oil. It closed into this zone. Previously, we've seen wick, always selling off early. This time it closed up high. That's similar to what happened over here. So could oil be looking for a breakout to the upside? Oil does love high interest rates. So if we see rates start to spike, the 2-year goes above, all these forward rates go above, oil actually may move a little bit more, and we could see ourselves at 93 a barrel relatively soon. Doesn't mean it's going to 150 or anything like that, but it could spike a little bit higher. That's the first sign of this supply getting tested and actually, in some ways, maybe even partially broken. Remember, it went above everything but this little alert I have above here. I'll set one down below because I think if that does change, let's say we make a lower low here, then we're probably looking at shorting oil. But at this stage, I would remain mostly on the bullish scale here because of that last close. That was significant. Let's take a look at the daily. You can see it did reject off it. But if we get another daily bullish candle, that'll be the first time this level has been not only tested, but it's been closed above. The close is the key. We often talk about that on the channel. It's really important to think about. Tesla came off. We got that initial gap fill over here, and it's just been sell since that point. We're not quite back down to that 203, 200 support yet. It still could be accumulating position. I mean, a lot of you guys like this price. I've still got the 180 as a potential zone for Tesla. I don't really change that. If the market continues to weaken here, if we continue to see what we're seeing on some of the big tech stocks, I still think very easily Tesla could swing down here and hit those zones. But for now, you're looking at kind of that buying area around that 205, 200 for some reaction. What you want to see around that zone is wicks. You want to see buyers coming in and just saying, yes, I want it. Yes, I want it. And if you see a few, it usually gives you a good chance that that's a key zone. There's almost no stopping these big tech stocks. Google is getting thrashed. If you thought the market should be making new lows as Google's getting thrashed, then you can just tell how 2022 has been so wild for us all. It's back in the zone. It's certainly in a key level. This was structure zone back in 2021, and we obviously, or 2020, we obviously saw it in November into October, January. It hasn't come back to the 2020 highs yet, but this is still a big structural level. You'll notice I have a little alert set here for 84. I'd like to see what the market does if it comes through here. Maybe some buyers instantly commit to that gap fill, something I am watching. And again, you just set these levels, and if they get hit, then you get an alert for them, and all of a sudden you can then make a more informed decision. Generally on these big days, how many of you have missed trades? Put it in the comments down below. Have you ever missed a trade because you didn't set an alert? Tell other people about it. Help everyone in this community. I'm saying it to you guys. I've done it. I've missed so many trades by not setting alerts. So make sure you have software that allows you to do that. Apple did close the gap, which is pretty big deal. I think closing the gap is a big one. It could point towards maybe a bullish session next session. We're back on demand here. We'll take a look at the S&P 500 and Dow soon, but we moved down heavily. It was a big sell-off, and we're back into the demand. We filled the gap. That's kind of a zone where you could see buyers coming back in for Apple, even though it does look pretty bad on some of these timeframes. Obviously, if the weekly closes at a new low, that's going to be an engulf. It's going to be pretty bad for this market across the board. And if Apple fails, there's not much looking good. XLY XLP continues to warn us that this market is sick. The lifeblood of the US market, innovation, semiconductors, XLK, technology, consumer discretionary, it's all gross. And consumer discretionary is showing us that the market would prefer to own staples over it. This is not what you see generally during a recovery. Now we're getting down into kind of those previous lows as a ratio here. So maybe things are about to change, but it's still very sick at the time of this recording. Let's move over to the Dow. Did it do what we wanted it to? Yes, it did. It sold off that level. This was the beautiful trend line. I'm really happy with this. Obviously, it's because we thought about it, and it kind of makes me think there's still lower to go, but to get there may take a few kind of sessions, and it won't be just easy. Now, I wanted to bring this up because notice the Dow takes the high in the liquidity. This is why I hate the Dow many times to trade. For a swing trader, for an options trader, it's not a problem, but this is very annoying. When you get highs getting taken like this, it's frustrating. It's harder to do so on the S&P 500, and the Dow is only 30 stocks, so it's very easy to push to certain levels. Notice it takes out the stop losses, squeezes you, and pushes down. This will come in very important when we take a look at the S&P 500 soon. What about the DAX? Yep, it's coming off as well. Again, the 2 hour shows us some weakness here. We've broken through that kind of more consistent trend line on this really nice squeeze up, and it doesn't really matter how we draw it. We've kind of gone a little bit lower. Let's move over to the US 2000, the Russell. Well, the small stocks also made a new low. It is a role reversal. I could still see some bounces coming off here, but we would have to see some serious structure. I could see it going like this and then this at this stage. And that's what I guess the primary case is. Potentially some structural bounce. Remember, where did the market close? The market closed close to its lows, and we'll look at that with the SPX. In fact, I'll just show you now. Look at this. Look at the daily, right on the low. Now, when you go on the low, what's happening? Well, the market just closed. It couldn't sell anymore because it closed. So realistically, when you come into the next session, what's to say that the sellers don't want to continue to sell it off? And if it does rally, what's to say this big reaction wasn't correct? Remember, we've seen a lot of these where we've had initial rallies or structure, and then we've seen continuation. This was a fairly big move in the market. It was probably considered. The volume was obviously relatively strong. And what we are looking for here is when we see the close low, there's a good chance that we will have a bounce or some relief. But again, that's where sellers often do come in, and they come through to get better price on that market towards the sell side, create that liquidity. The US 100, the Nasdaq, is pretty bad in comparison. It's sitting right again on its demand. Previous wicks on all these closes. This time around, no wick. Interesting. Does that tell us that this is a weaker potential rally here? It points towards that in terms of statistics. Usually you want to see wicks. We're not having the wick, and that's not really great. So if we get rallies, potentially they're met by sell demand. Again, this could be all part of distribution. Some people say that's an inverse head and shoulders, Tom, left shoulder, head, right shoulder. Well, I hope you're right for your sake. Obviously, if the market does end up making a new high, then we can move towards, moving through to these levels. But at this time, yes, I think there could be demand here. The question is, how strong could that demand be? Is it just going to be a small rally? We have to look for the signs, smaller time frame. Let's talk about the S&P 500 though. Notice the wick that happened during the news did not take the high. This is really important. And it actually, well, I'm not going to say hit perfectly. This was the white line. If you don't believe me, go and have a look at the previous video. And this was pretty much where I expected the market to sell off from. Now, I didn't know it was going to go new low and then sell off like this. My suspicion was it was going to do this, potentially into the announcement, do that kind of thing, and then bang. And it pretty much worked as we thought. The S&P 500 held some of the best kind of trade for the session. It's now down at the previous buy zone. So we saw previous demand here, and we're there again. So we certainly are at a zone where we could see markets find some form of support. I think the market will want to go down to 36.76 or around this level. The main reason is it's kind of one of the most traded zones throughout this entire block of trades from recent days. And if the market rallies, remember, it's more likely to rally kind of like a 3,800, something than here. Maybe it'll push even higher, but these zones like 3,800, 3,840, those two levels are more likely to be where the sellers sit. And I could see rallies being met by some form of pressure throughout these. Is the rally over yet? No, it needs to hold this zone, but the rally is not necessarily fully over. You could predict that it's going down more, and you could say, okay, well, if we look at this market, here's our Wyckoff, we've got that low max pain. This is just all SOS, Tom. It's going up, it's going up, it's going to that trend line. And you could be correct, but the problem is, imagine this. Imagine if it does, let's say it rallies. So let's say it rallies up, goes down, makes a new low. Test this level, lower high. If it then breaks below, what's going to happen? Well, it's kind of like this was all distribution. So if this was all distribution, what do we see? Most likely a big capitulation fear, and that would push that 3250 narrative that a lot of people have been talking about, potentially a big sell-off in these markets. Both cases are very valid. And for people to tell you exactly they know where this market's going, I could see some bearish cases say, I know where it's going bearish, and maybe be correct. The bullish side is still hard to see. We need probably China to do a pivot on the COVID policy. We need, of course, the Fed to actually show that they've got this, let's say, inflation under control. And then also we have to then say, well, is this a Goldilocks moment where we get a soft landing? Remember, Jerome said in his speech, unlikely to see a soft landing. It's narrowing, he said, it's narrowing. And that's because we're going to most likely have sticky inflation. Inflation for longer, inflation that's prolonged, super annoying inflation, all those types of things. So we're on demand here. We'd like to see actually a bit of a rally over the next 24 hours ideally, or some consolidation with a short, similar to some of the other sell-offs, and then probably move back into this level. And if that does happen, I still think this is probably the more likely scenario in that case. For buyers, you want it to buy up now, and you want it to just basically rip a new level. You want it to just keep ripping and ripping and ripping, make a new high. I don't even know if this would stop it then, and you might move to 4,100. But as of the last 24 hours, it did start to look worse for the buyers, but I could see them at least having a sniff around this level. Let's refresh what's going on with the options this week, and we'll have a quick look here. Let's look at the expiration coming into the Friday. Again, 360 seems to be the put wall. It's unlikely the market can get underneath there. Max pain's 382, current stock price is 374. This is not a third week expiration, so the open interest is nowhere near the usual amount, but 360 seems to be the wall at this stage. The market wouldn't want to close too much under that, you would think, just to make maximum amounts of money. Bitcoin is weakening, though it has not fully weakened. You'll notice here we have an alert that we set over the last 24 hours below 20,000. We're still finding some buyers here. If the market ends up rallying and then starts to drop off, that could be a scenario. Also, we could see Bitcoin kind of just make a low rally similar to the stock market and then fall over. It's still bullish as of this time, but think about, again, a Wyckoff scenario. Here we have an accumulation. Here we have a breakout, like an SOS on Wyckoff, and then we potentially have a market that could go down. If it does, watch out down below. Again, the capitulation story becomes incredibly solid at that point, and it all kind of makes sense. I'd still, well, I don't think it can do this without the stock market, but this still should be technically filled at some point. We'll find out whether it can happen. We're at demand at the time of the recording. That's all we can do. We can only just say what we're seeing, what the most potential outlooks are. For the calendar for the week ahead, if we just quickly refresh this, always make sure you have your calendar. You can see here that the federal funds rate was as the expected rate, and we've got some bank holidays for JPY. Now we move forward to Thursday, and we end up seeing a few things. We've got the ISM Services PMI coming out 10 a.m. New York time, and then if we go through to Friday, we have the big one. Jobs numbers, unemployment. Is the US economy actually cooling? Do we see jobs starting to go potentially even negative or at least drop off? this is going to be an important figure for the Fed. They want to start to see some weakness in the economy because ideally they see weakness, they get inflation under control, and then they can turn the tap back on. And everyone knows that's what they want to do. Unfortunately, there's not usually a perfect scenario. If you enjoyed today's video, make sure, of course, to follow us over on Twitter or Discord. At FX Evolution is the handle. And if you're ever interested in finding out more about some of our courses and stuff, you can jump on over to fxevolution.com and have a look at some of the things. I highly recommend the Advanced Scalping Masterclass if you want to really navigate 2022 a bit faster and a bit easier. That doesn't mean you're just doing like 5-minute trades, by the way. I know that's what scalping is. It's more scalping, day trading into thinking about how am I going to get those 4-to-1 style risk reward trades. I want better risk reward, guys. I want to make $400 for every $100 I risk. That's the type of thing that you're looking for in these markets in 2022. And the good news is they are quite present. If you enjoyed everything, subscribe, smash the like button. We'll see you in the next one. Bye for now.